Very good afternoon, everyone. Welcome to the 6th of October weekly market review, the first Monday of October, and then we just finished the F1 weekend. Of course, you see the very handsome Gerald with us today. He just attended the morning strike, the gong session at SGX. How's your weekend, Gerald?
Yes, I think many of us were probably watching the F1 race last night. Then I had to wake up early today to attend a ceremony at the SGX Center, where we were just together with SIAS, seeing how we can support financial literacy.
Yes, that's our mission here at SIAS, and you can see how passionate Gerald is in this mission together with SIAS and SGX. So the weekend was a bit weird because we had the Friday expecting the non-farm payroll data, but that was blocked or shut off by the government shutdown, and I was staring into space on Friday. But that gave me a bit of space sort of to think of whether I should go to the F1. But then I did not also make it to the F1 because I'm still figuring out how do they drive from Suntec to Funan and back to Suntec in 1.5 minutes when I need to take 15 minutes. So I can't decipher that. But helping us to decipher what's happening in the market today will be Gerald. So Gerald, over to you.
Okay, thank you. I won't be able to explain how they get to Funan to Suntec in 1 minute or so. Okay, today's sharing is not catered to your individual needs and investment objectives, and hence should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so for many stock investors, last week brought good news, where we saw the S&P 500 and STI reaching record highs. The S&P 500 exceeded 6,700 points, closed the week at 6,716. As we can see from this chart, the tech names led the rally, with the Nasdaq showing a 1.3% gain as the optimism towards AI continued to boost sentiment towards the tech stocks. In Singapore, we actually have the STI doing exceptionally well last week, with a 3.4% gain and also reaching a new all-time high of above 4,400 points. So all of this came through despite the news of the US government shutdown. So you have probably read a lot of media reports about the US government shutdowns and wondering what this actually means for investors. Okay, so the background to this is that the legislators were not able to reach a funding agreement to keep the non-essential government functions open, and that actually led to the US government shutdown. I think despite this, we saw the US market actually going to new all-time highs. This is because the sentiment in the market today is that bad news is good news. So while we did not have the US non-farm payroll coming out last week, we did have some private sector labor market data, and all of it has been fairly weak in terms of the employment numbers. So that actually reinforced investor expectations for more interest rate cuts. The other implication is that if the shutdown continues, we already saw the non-farm payroll data not being released. What could also happen is that other vital economic indicators provided by the government could also be delayed, including the September Consumer Price Index report that is scheduled for 15th of October. Okay, so all of this makes it even more difficult for economists, for market analysts to be able to decipher the trends in the market and be able to make predictions around what the US Federal Reserve is going to do. Okay, in Singapore, we also saw the STI reaching a new all-time high of above 4,400 points. So we saw the STI outperforming the S&P 500 as well as the Nasdaq. So part of it is driven by the safe haven perception for the Singapore market. But at the same time, through the course of this year, we have also seen various measures to actually boost the Singapore equities market. So in terms of the top performers, we have got SGX with a 5.9% gain, DBS up by 5.1%, City Developments up by 5.1%. I think in particularly SGX is being seen to be benefiting from the higher trading volume as well as the growing pipeline of potential listings on the Singapore market. Okay, in terms of the top losers, there were only two names in the STI that had negative returns in the past week, and that would be Genting and Singtel. But we saw that even amongst the five worst performers in the STI, they still had absolute gains in terms of the share price. The name that I wanted to go through in a bit more detail today is Keppel DC REIT. The share price has been recovered strongly since April this year, and it's also one of the better performing REITs. Not only seem to be benefiting from the lower interest rates, but also as a play on the growing demand for data centers in the region. Okay, so last week they announced the acquisition of a data center in Tokyo. So effectively, this will be done together with their parent, Keppel Limited. And effectively, what we see here is that on a 100% basis, the data center is valued at about 82 billion Japanese yen, translating to about 707 million Singapore dollars. And for the 98.5% effective interest, that will be valued at 80.8 billion Japanese yen or 696 million Singapore dollars. So some of the key characteristics of these assets, the data center was newly completed in 2025. Effectively, there is a contractual agreement for 15 years with a renewal option of up to 5 years. And this is actually a freehold asset. Okay, so generally in terms of the strategy of Keppel DC REIT and how this would fit its strategy, what the REIT has been trying to do is to be able to capture more opportunities in established data center hubs, and Japan is definitely one of the key data center hubs globally. Okay, I shared earlier that the data center asset is 100% contracted to a leading global hyperscaler for 15 years with annual rent escalation. So that provides visibility in terms of the rents that is able to get from this particular asset. Okay, so I mentioned earlier that Japan is seen as one of the key data center markets. Effectively, that is because it serves as an interconnection gateway between Asia as well as Americas. So it is seen to be benefiting from this structural tailwind towards the data center market. In terms of the location of this data center, some of you may have concerns around is it then prone to earthquake or other natural disasters? So effectively, what the REIT manager has shared is that this data center is actually located at one of the most established data center clusters in Japan. It's got good connectivity, it has a favorable inland location, as well as a low seismic risk. Okay, the next question that we are very interested in will be whether this is accretive to the distribution for unit holders. So what we see here is that the acquisition is expected to be accretive to unit holders by about 2.8% based on the pro forma 2024 numbers. Okay, some other key points around the lease that's been signed. With the data center coming in, Keppel DC REIT's entire portfolio occupancy is expected to improve slightly to 95.9%. Because this is on a 15-year lease, the weighted average lease expiry will increase by about 0.3 years to 7.2 years post the acquisition, and it will effectively see an increase in income diversification across its portfolio of clients. Okay, so together with this, Keppel DC REIT has announced a preferential offering, effectively allowing entitled unit holders to subscribe to the units of Keppel DC REIT. So the allotment ratio is on a 80 for 1,000 basis, which means that new units will be issued on the basis of 80 new units for every 1,000 existing units owned by the entitled unit holders. The issue price is at $2.24, which is at a discount to the last closing price of Keppel DC REIT. Okay, if I were to look at the valuation of Keppel DC REIT at this point in time, dividend yield of about 4.2%, price to book ratio of about 1.5 times. So I think though that is reflecting the investor sentiment towards the growth, towards the data center market. Okay, so some timelines to take note of for those of you who are interested in the preferential offering. Effectively, the preferential offering has opened on the 3rd of October, and the last date of the application will be on the 13th of October. Okay, so with that, I've shared about Keppel DC REIT in terms of what to look out for this week. It is a relatively quiet week as we have yet to start the third quarter earnings season. We also have uncertainty around the US economic data points because of the US government shutdown. So those are some of the key things that we can actually still keep a lookout for in the coming week. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for the serious stuff, and we hope that you guys have a clearer picture of what you need to do or can do with the Keppel DC REIT preferential offering. So Keppel DC REIT is one of the most established sort of data center REITs listed in Singapore. And of course, in a data center REIT that we covered before, you will be able to sort of participate in the tech rally or the AI revolution, while also get stable returns because the product itself is a REIT, which will pay out most of their earnings through the rentals, okay, through dividends, DPU to the investment or the unit holders. So back to our index, the STI index. As you can see, last week our STI index jumped by 3.4%, and we are now above the 4,400. We zoomed past the 4,400 level already. So Gerald was asking me before the show, hey, all the indicators are showing overbought signal, and then where is the STI heading? Doesn't seem to be a technical pullback. So my opinion is yes, that is the case. It happens from in the market from time to time, but we should always stay disciplined. So if I miss the STI rebound at the 4,300 level or the 4,275 points level, which is the lower bound of the Bollinger Band, somewhere in the last week of September, then I should not chase the rally. So where do I see the STI rally going? Definitely, there is no sort of a next level higher for us to reference in terms of historical levels, but definitely 4,005 would be the first psychological level that traders or investors will be looking at. So looking at STI this morning at 4,415 points, we are about 85 points toward that 4,500 psychological level. From there, likely we will see a technical pullback. The first support, 20 days moving average at 4,300. And then the next support, which is the 50 days moving average in blue, which was the rebound that you saw happen on end of September. That's now at 4,275 points, okay? So these are the two key support levels that we are looking at for the STI. And then if you measure the risk and reward levels, you have an 85 points level up. But then from the current 4,400 level back to the 4,300 or 4,275 points level, that is a 100 points drop. So the risk and rewards really isn't in the favor of chasing the upside, in my opinion. So I would rather wait for it to pull back towards the 50 days moving average around the 4,300 level before I get back into the STI index. So if you miss the boat at the end of September, then of course we have to wait for the tide to pass, and then after that we get back in on a safety level. Similarly, some of the audience also asked me, how about DBS? It went all the way up to $53. So if we miss that $50 level, the $50 round number psychological support level a few weeks back at the end of September, then definitely we will have to wait for DBS to come back down again to give us a margin of safety before chasing it again. Alternatively, you can look at some of the REITs we are having that are giving us very good dividends, like Keppel DC REIT, which Gerald shared earlier. Those are the key stocks that have not run out as fast as the banking stocks or the STI index, and that could still have some windows of opportunity for you to get back in to some of the value property plays or REITs play in the Singapore market. Okay, next, let us move to the US indices. Okay, so as you can see, even with the US government shutdown, like what Gerald shared earlier, the US index is still flirting with the all-time high. Even last Friday, we also saw a new all-time high at the 47,000 level for the Dow Jones index. It breached that 47,000 handle and went up to 47,049 points, but it's just closed slightly below that 47,000 handle at 46,758 points. That gives them a 0.5% gain on Friday for the Dow Jones index, and it's up more than 1% for the trading week. Okay, so then where is the Dow Jones index heading, given that we are in the all-time high region now? So similarly, I also would not chase, because looking at the Dow Jones index, which I've been saying for a few weeks, the pivot level for the Dow Jones is where the 20-day moving average is. You can see that in the past few weeks, it has been using the green color line, which is the 20 days moving MA at 46,110 points now. Okay, the support level would be the lower bound of the Bollinger Band with the 50 days moving average at 45,336 points. So that was when it touched the blue color line. That was all the way back in early part of August. So we are now waiting for the Dow Jones index to come back. But generally for the US index, if you want to participate in the US index, it's always good to sort of spread out your risk or investment size. So same thing again, chasing the market is not really ideal for most investors unless you are a very professional trader. So time in the market is always more important than timing the market. Okay. So first support 46,110 points for the Dow Jones index, with more support coming in at 45,336 points, which is a 50 days moving average. MACD indicator is telling us neutral reading, even though we got a slightly positive reading, but you can see the MACD and signal line is telling us that there's no trajectory, no angle of ascent or descent. So likely it will be in a range bound formation going forward. And the RSI having reached the 68 level last Friday, 2 points away from the 70-point overbought mark. The previous time we hit above the 70 points somewhere in July to 75 points, we see a consolidation happening on the Dow Jones index, and that is where I am expecting the Dow Jones index to do. Okay, so looking at the consolidation range, we will be referencing the previous high on 22nd of August. That is 45,757 points, and this range over here will likely be the range bound kind of a formation that I'm expecting from now until the end of October. Okay, so we'll keep you updated on this movement on the Dow Jones index. Next, let's move to the S&P 500, which also clocked a similar 1.1% gain that we saw last week. So you can see that we touched a new all-time high on Friday again at 6,750 points, and then we closed around 6,715 points. Okay, so let me just delete this. Okay, so the referencing levels that we are looking at now for the S&P 500 20 days moving average around 6,627 points, lower bound of the Bollinger Band with the 50 days moving average around 6,500 level. So that is the key support that I'm looking at for the S&P 500. Anytime you pull back to this level, it is a buy. The previous time we came close was somewhere in the early part of September, as well as the end of July period. Okay, so the boat might have sailed, but then will this rally continue? Nobody knows. And I would now reference the likely going to be a 7,000 handle that we are trying to aim towards the end of the year. Okay, So the MACD indicator now is slightly positive, but you can see trajectory is neutral. So MACD is not telling us any kind of direction. It is the index is going to move right now. The RSI at 69 points, also 1 point away from the um, sort of the previous high that we saw in 22nd September at about the 74, 75 point level. So in the case of a very strong rally, how you use the STI index would be to look for a bounce at the 50-point mark, okay? If the rally continues to stay in that formation, in that uptrend channel, then look for the RSI to go to the 50-point level, and hopefully at the 50-point level, you get some support on the 20 days moving average to carry on to ride the wave of the uptrend in the short-term period, okay? So we'll update you when the RSI hit the 50-point level and below the 20-day moving average. That is the key sort of a setting or this key setup that we want to have before we ride on the S&P 500 rally up towards end of the year, towards the 7,000 mark. Next, let us move to the tech-heavy Nasdaq Composite Index, which was the best weekly performer among the 3 US indices. I think it was up about close to, let me double check, close to 2%. Sorry, 1.32%. Okay. So the Nasdaq Composite Index hit a high of 22,925 points, just about 70 or 80 points away from the 23,000 psychological level. I have no doubt that it will push through that level. But then on key support level wise, you can see that the 20 days moving at 22,400 will be the pivot level, not a support. But very strong support will come in at the 50 days moving average at 21,780 points, coinciding with the low bound of the Bollinger Band, plus a double top formation that could be a change in polarity. Okay, the MACD indicator is neutral now, but the RSI is close to the overbought level of 70. So do take note for the Nasdaq Composite Index, we would want the RSI to come back down to the 50 points level, as you can see on this 3 occasions over here, for it to rebound and hopefully nearer to the 50-day moving average for us to ride the AI tech wave on the tech heavy index. Okay, so that's all I have to share today. Anything else to look out for, Gerald?
So I think it is quite light in terms of the economic data for this week. We also don't know how long the US government shutdown will extend for and what it means for the economic data that is supposed to be coming out. We also don't have much earnings results this week until we get to the next week and the week after, where more companies are actually reporting. In the meantime, the stocks are at all-time high. So I think that is something that we need to be watchful about, and what that actually means in terms of the performance going into the fourth quarter of this year.
Yes, so also do look out on the 9th of October, which is this Thursday. There might be a FOMC meeting released, which is scheduled, but due to the government shutdown, we do not know that whether that will come out as planned. But so do keep a lookout, and we'll update you if there are further developments on this economic announcement next week. So that's all the time that we have today. Thank you for joining us again this week on the weekly market review, and we'll see you next week on the next session. Goodbye.